The Unseen Rhythm: Decoding the Economic Cycles That Shape Our World. Part 1. The Enduring Allure of Pattern Recognition in a Chaotic World. An analysis of the video's persuasive power. The human mind abhors randomness. From ancient celestial observations to modern data science, our innate drive is to identify patterns, to bring order to chaos, and to find a predictable rhythm in the seemingly unpredictable dance of life. This fundamental psychological yearning is perhaps nowhere more potent than in the realm of finance and economics, where fortunes are won and lost on the perception or misperception of underlying order. The video transcript provided offers a masterclass in leveraging this primal human need, crafting a compelling narrative that resonates deeply with its audience, even in the absence of complex quantitative data. Its success is not accidental. It is a meticulously constructed, persuasive argument built on universal psychological triggers and an intuitive narrative arc. 1. The universal hook: gold as a primal symbol. The video immediately establishes a profound premise. Behind every crisis, boom, and seemingly sudden upheaval, there lies a recurring pattern: the economic cycle. It then grounds this abstract concept in a tangible, emotionally resonant example: gold. Gold is not merely a commodity. It is a primal symbol embedded deeply within the collective human consciousness, representing ultimate value, a hedge against fear, and a historical anchor. By invoking gold, the video bypasses intellectual skepticism and immediately taps into a visceral, almost instinctual understanding of wealth and risk. The mention of its price or historical significance instantly captures attention because gold is universally understood to be a benchmark, a safe haven, or a harbinger of change. This anchoring in a universally recognized, emotionally charged asset provides an immediate, compelling reason for the viewer to lean in, bypassing the need for an initial, dry explanation of economic theory. 2. The cultivation of an in-group mentality. One of the most powerful persuasive techniques employed is the deliberate creation of an in-group versus out-group dynamic. The narrative subtly divides the world into two camps: the dom-dung, the crowd, those who are reactive, emotional, and ultimately suffer losses by acting against the cycle, and the nui hiu chu ki, those who understand the cycle, who are calm, patient, and prepared, reaping rewards by acting in harmony with it. This framing is incredibly effective. It speaks directly to the viewer's desire for belonging, for superiority, and for access to privileged knowledge. By promising to reveal the secrets of the people who see the season, the video implicitly invites the viewer to join this select, intelligent in-group. This psychological invitation fosters engagement, as viewers naturally want to differentiate themselves from the confused crowd and align with the knowledgeable few. It suggests that the wisdom being imparted isn't just information, but a pathway to an elevated status of understanding. 3. The potency of simplified pattern recognition. The video masterfully simplifies complex historical events into easily digestible cause and effect patterns. The example of 2008, millions losing homes and jobs, stock markets plummeting, is juxtaposed with the few who bought cheap stocks and real estate, becoming millionaires years later. This is not just a story, it's a simplified illustration of a predictable cycle. The video consistently reinforces this idea through examples from the dot-com bubble, the 2011 to 2013 Vietnamese real estate freeze, and the 1980 seconds Japanese bubble. By presenting these chaotic historical episodes as manifestations of a repeating cycle, the speaker imbues the audience with a sense of order and forecastability, offering a comforting illusion of control over seemingly uncontrollable forces. This reduction of complexity into understandable patterns is a powerful cognitive shortcut that appeals to our innate desire for clarity. 4. The FOMO, fear of missing out, catalyst. The entire narrative is steeped in a subtle yet potent sense of urgency. The metaphor of seasons in the economy, where one who knows the season knows when to sow, when to harvest, when to hoard, and when to mitigate risk. While most of us go to work, invest, Start businesses without anyone teaching us how to recognize the season creates a powerful fear of missing out, FOMO. It implies that without this crucial knowledge, the viewer is analogous to a farmer planting in winter, destined for failure. This urgency isn't overtly aggressive, it's an intelligent nudge, reminding the viewer that opportunities are fleeting and knowledge is the key to seizing them. The message isn't just, here's an opportunity, but here's critical knowledge you might already be lacking, and it's costing you. 5. The identifiable prime mover, the Federal Reserve and global central banks. While not explicitly detailed in the excerpt provided for the analysis of the video's appeal, the overall transcript and the earlier analysis of its core propositions highlights the role of central banks, particularly the U.S. Federal Reserve, as a key driver of these cycles. By identifying a clear, singular catalyst, for example, the Fed cutting interest rates, the video provides an understandable cause and effect mechanism for the entire thesis. This externalizes the seemingly random fluctuations of the market, offering a comprehensible mover behind the movements. This appeals to our cognitive need for attribution and a clear understanding of agency, rather than confronting us with a complex web of interconnected, opaque forces. It transforms the market from an unruly beast into a system with identifiable levers. 6. The consumable list structure, a promise of tangible takeaways. The promise of a structured learning journey, from basic concepts to how billionaires like Warren Buffett or Ray Dalio use it, and how to apply that knowledge to your personal life. Long-term investment. Smart Startups provides a clear roadmap. Even the mention of 5 types of assets from the earlier provided analysis, though not in this specific transcript segment, is a classic and highly effective content structure. It tells the viewer exactly what to expect, making the potentially overwhelming topic of economic cycles feel manageable and actionable. This structured approach caters to our desire for clear, tangible takeaways that can be immediately applied. 7. The metaphorical eloquence. Cycles as seasons and waves. The use of powerful, relatable metaphors like economic cycles as seasons or great waves. 2.05. Chuki Kintejong Nukun Songlon significantly enhances the video's appeal. These metaphors are intuitively understood, making complex economic phenomena accessible. Seasons convey inevitability, predictability, and the wisdom of preparation. Waves convey power, movement, and the dual nature of destruction and opportunity. By framing economic events in such vivid, natural terms, the speaker creates an engaging, memorable, and easily digestible narrative that transcends dry academic discourse. It transforms abstract concepts into vivid, relatable imagery. 8. The call to empowerment and long-term vision. Crucially, the video explicitly distances itself from get-rich-quick schemes. 322. Day Kong Fai La Video, Hua Hen Lam Giao Kuptuk. Instead, it champions a sustainable foundation, 328, and a long-term path, 333. This builds credibility by aligning with wisdom and prudence rather than speculative greed. It positions the speaker as a guide to enduring wealth, not fleeting gains. This appeals to a more mature, thoughtful audience seeking genuine understanding and lasting financial stability. The call to like and subscribe then becomes an act of joining a community committed to this long-term, informed approach, further solidifying the in-group identity. In essence, the video's success lies in its ability to tap into universal human needs for order, belonging, and empowerment in the face of uncertainty. It doesn't just present information, it offers a compelling narrative, a psychological invitation, and a promise of transformative understanding, making the complex world of economic cycles feel not just comprehensible, but actionable. Part 2. Key Themes and Core Propositions. Unpacking the Economist's Lexicon. The transcript, while presented as a broad introduction to economic cycles, is underpinned by several key themes and core propositions that align with established economic theories and investment philosophies. These elements form the intellectual scaffolding of the video's persuasive narrative. 1. The primacy of cycles, a foundational law. The central, overarching thesis is the inevitability and regularity of economic cycles. This is presented not as a mere observation, but as a fundamental law governing financial markets and economies. The video explicitly states that behind every crisis, every boom, every seemingly sudden fluctuation, there is a repeating pattern that is called the economic cycle. This proposition directly echoes classical and neoclassical business cycle theories from the early observations of Adam Smith 432 to the more systematic frameworks of Juglar, Kitchen, Kondratieff, and Schumpeter. The video emphasizes that these cycles are not random occurrences, but a structured, rhythmic movement of the economic body. It argues that understanding this rhythm, like seasons, 0-40, is the ultimate differentiator between the crowd and the knowledgeable. 2. The duality of crisis and opportunity, destruction and creation. A recurring and powerful theme is the duality of destruction and creation inherent in economic cycles. Crises are not merely periods of loss, but are presented as crucial moments of purification and opportunity. The examples of 2008-012, the Vietnamese real estate freeze, 116, and the dot-com bubble, 153, consistently illustrate this point. While the majority suffer, a few, who understand the cycle, find unprecedented opportunities to acquire undervalued assets. This aligns perfectly with Joseph Schumpeter's concept of creative destruction, 439, Sang Tao Va Hui Diet, where old, inefficient structures are swept away to make room for new innovations and more robust entities. For example, Amazon, Google, emerging from the dot-com crash. The video posits that the problem is not whether the market goes up or down. The market always fluctuates, but rather where you stand in the cycle and how you prepare for the next phase. 2.10. 3. The power of preparedness and patience. Discipline over emotion. The video strongly advocates for discipline, planning, and patience over emotional reactivity. The contrast between those who act on emotion, hung fun qua mook, overly excited, hong long, panicked, and those who understand the cycle, dim tin, calm, koke wach, planned. Biet dung teuri giam de lam luri, to know how to use time as an advantage, is a central pillar of its message. This is a timeless investment principle, popularized by figures like Warren Buffett. Be fearful when others are greedy, and greedy when others are fearful. 13. And encapsulated in the idea that long-term wealth is built by counter-cyclical behavior. The narrative repeatedly emphasizes that understanding the cycle allows one to sow when one should sow, harvest when one should harvest, hoard when one should hoard, and prevent risks when necessary. 053. This isn't about predicting exact dates, but about knowing the general phase and acting accordingly. 4. Cycles as a map for personal finance and career. Beyond macroeconomics and investment, the video explicitly positions understanding economic cycles as a practical guide for personal finance, long-term investment, and even smart entrepreneurship. It aims to transcend abstract theory, promising to show how to apply that knowledge to your personal life. 3.10, including managing personal finances, making long-term investments, and starting businesses. This is a crucial element that broadens the appeal from just investors to anyone seeking financial stability and success. The connection between macro cycles and micro decisions. For example, when to borrow, when to save, when to expand a business, makes the content directly relevant to the daily lives of viewers. 5. Long-term wealth building, not a quick fix. The video firmly rejects the notion of get-rich-quick schemes, emphasizing that its insights are for building a sustainable foundation. 3. And for those on a long-term path, 3.33. This commitment to long-term thinking and sustainable wealth creation distinguishes it from much of the sensationalist financial content online. It frames understanding cycles as a strategic tool for intergenerational wealth building, not merely speculative gains. This focus on durability and resilience appeals to a more mature and discerning audience seeking genuine financial wisdom. 6. Actionable indicators. Reading the signals. The video empowers the audience by pointing to everyday economic indicators as keys to identifying the current phase of the cycle. It highlights metrics such as GDP, inflation, interest rates, and unemployment rates. 9. 11. It provides clear interpretations. Strong GDP and low unemployment for expansion. Rising inflation and tight interest rates for a peak. Falling GDP and rising unemployment for recession. And easing monetary policy for recovery. This translates complex macroeconomic data into accessible signals, equipping viewers with practical tools for observing and interpreting the economic landscape around them, moving beyond abstract concepts to observable reality. 7. The metaphorical framework, seasons, waves, and trains. The consistent use of vivid and relatable metaphors, particularly 4 seasons, 0-40, for the phases of the cycle, great waves, 2-0-5, for their transformative power, and even a train journey, 249, serves to demystify complex economic concepts. These analogies make the abstract tangible, helping the audience grasp the cyclical nature, inevitability, and the wisdom of preparation. They transform what could be a dry lecture into an engaging and memorable narrative. These core propositions collectively establish the video as a guide to understanding, navigating, and ultimately thriving within the inherent rhythms of the global economy, emphasizing wisdom, discipline, and a long-term perspective over speculative, emotional reactions. Part 3. The Midas Mirror and the Rhythm of Empires, an academic monograph on economic cycles. Engaging opening. The dance of illusion and reality. The world of finance is a grand theater, often appearing chaotic, its stage populated by frenzied crowds, whispered rumors, and the seemingly arbitrary ascent and descent of fortunes. Yet, beneath this veneer of randomness, there exists an intricate, almost hypnotic rhythm, a recurring ballet of expansion, zenith, contraction, and rebirth. This rhythm, which we term the economic cycle, is not a mere statistical anomaly or a historical footnote. It is the very heartbeat of global commerce, a fundamental law that governs the ebb and flow of capital, opportunity, and despair. To the uninitiated, each boom feels like an eternal spring, each bust an inexplicable winter. But to those who have trained their gaze, who have cultivated the art of seeing beyond the immediate headline and the emotional tempest, these seemingly unpredictable shifts reveal themselves as inevitable chapters in an ancient, repeating story. My journey through the annals of economic history and contemporary financial markets has convinced me of one undeniable truth. The greatest differentiator between sustained prosperity and perennial struggle is not superior intellect or insider information, but the profound comprehension of these underlying cycles. It is the ability to discern the season of the economy, to understand its inherent dynamics, and to act not on fleeting emotion, but on reasoned anticipation. This monograph, inspired by the compelling narrative of the provided transcript, seeks to unravel this profound truth. We will move beyond the superficial analysis of price movements and delve into the deeper, almost theological undercurrents that dictate the rise and fall of nations, industries, and individual fortunes. This is not a promise of instant riches, for such promises are the siren calls of speculation. Rather, it is an invitation to cultivate a wisdom that transforms uncertainty into an advantage, turning the relentless tide of economic change into a powerful current that propels us forward rather than sweeping us away. Body, the unfolding tapestry of cycles, from Adam Smith to artificial intelligence. The transcript introduces a concept that, while seemingly complex, is as old as organized human commerce, the economic cycle. It posits that behind every crisis, every boom, every seemingly sudden fluctuation, there is a repeating pattern, 0-6. This assertion is not a novel revelation, but a re-emphasis of a truth observed by thinkers for centuries. updated for the modern investor. Let us deconstruct this profound observation, tracing its intellectual lineage and contemporary manifestations. The earliest glimmerings of cyclical economic thought can be found, as the transcript notes, 432, in the writings of Adam Smith in the 18th century. Though not using the term economic cycle in its modern sense, Smith, in The Wealth of Nations, 1776, observed the natural progress of opulence and recognized that the expansion of trade and industry was not linear, but subject to periods of varying prosperity. His focus was on the division of labor, capital accumulation, and market expansion, but his observations implicitly suggested an ebb and flow to economic activity. The inherent human tendency towards optimism leading to overinvestment, followed by a necessary retrenchment, was an unspoken undercurrent in his work. Moving into the 19th century, the concept gained more scientific rigor. Clément Juglar, a French economist, is often credited with the first systematic statistical analysis of economic cycles. His 1862 work, Des crises commerciales et de leur retour périodique en France, en Angleterre et aux États-Unis, on commercial crises and their periodic return in France, England, and the United States, meticulously documented recurrent patterns of expansion, crisis, and liquidation in commercial activity, typically lasting 7 to 11 years. These Juglar cycles, as they became known, were largely attributed to variations in investment and credit, echoing the transcript's later emphasis on interest rates and capital flow. 2:35, 4:57. The early 20th century brought further refinement. Joseph Schumpeter, an Austrian economist, infused the concept of cycles with a dynamic, almost evolutionary perspective. His theory of creative destruction, 439, Sang Tao Va Hui Diet, is a cornerstone of understanding why cycles are not merely repetitive, but transformative. Schumpeter argued that economic development is driven by waves of innovation, new technologies, new products, new markets, or new organizational forms. These innovations lead to periods of rapid expansion and prosperity, the spring and summer of the transcript's metaphor. But they also inevitably disrupt existing industries, rendering old technologies and business models obsolete. This process of destruction is painful, leading to recessions and depressions, the winter, but it is also essential, clearing the way for the next wave of innovation and growth. The transcript's examples of Amazon and Google rising from the ashes of the dot-com bubble, 153, perfectly illustrate Schumpeter's powerful idea. It is not chaos for chaos's sake, but a necessary, albeit often brutal, evolutionary process. Beyond these fundamental intellectual pillars, contemporary economic thought has categorized cycles by their approximate duration and underlying drivers, as mentioned in the transcript, 457. Kitchen cycles. Approximately 3 to 5 years, often linked to inventory adjustments and short-term production fluctuations. 4:57. Vundeton Kovasan Zuat. These are the most frequent and least severe cycles. Juglar cycles, medium term, approximately 7 to 10 years, driven by investment in fixed capital, credit expansion, and banking dynamics. 5:4. Do-tu, Tingdung, Va Ngon Hag. These are the business cycles most commonly referenced in general economic discourse. Kondrativ waves, approximately 40 to 60 years, reflecting major technological revolutions and shifts in energy paradigms. 5:10. Thedoi Kongne, Va Nang Luong. The transcript's historical examples, the first industrial revolution with steam and steel, then electricity and chemicals, and later information technology, 5:23, are direct references to these long wave cycles. These macro shifts fundamentally reshape entire eras, creating entirely new industries and rendering others obsolete. The transcript's strength lies in its ability to distill these complex academic concepts into relatable narratives, making the case that these cycles are not just a matter for governments or giant corporations. It infiltrates every family, every individual. 551. This democratization of economic insight is crucial, as it empowers the individual to see themselves not as a helpless bystander, but as an active participant in this grand, unfolding drama. The human element, the peril of emotion and the virtue of discipline. The most profound insight in the transcript, reiterated throughout, is the detrimental role of human emotion in navigating these cycles. Those who act on emotion are overly excited when the market rises, panicked when recession comes. 222. This observation is a timeless truth in behavioral economics, a field that blends psychology and economics to explain why human decisions often deviate from rational models. Loss aversion. Daniel Kahneman and Amos Tversky, pioneers of behavioral economics, famously demonstrated that people feel the pain of a loss approximately twice as intensely as they feel the pleasure of an equivalent gain. This loss aversion fuels panic selling during downturns, where individuals are desperate to avoid further losses, often crystallizing those very losses at the worst possible moment. For example, Banthao, 13.6, 1613, 21:23, herding behavior. The transcript frequently references the Dam Dung, the crowd 546, 1048, 1236, 1553, 2046. This alludes to herding behavior, where individuals tend to follow the actions of a larger group, assuming that the group's collective wisdom must be correct. During expansions, this leads to irrational exuberance and asset bubbles, as everyone rushes to buy, driving prices far beyond intrinsic value. For example, Bong Bong, 1236, 1553. Conversely, during contractions, herding leads to panic selling, exacerbating market declines. The internet and social media have only amplified this phenomenon, making it easier for collective sentiment, both positive and negative, to spread rapidly. Confirmation bias. During periods of economic expansion, individuals tend to seek out and interpret information in a way that confirms their existing belief that economic growth will only go up 15, 13, 17.9, 24 to 24. This confirmation bias blinds them to warning signs, making them susceptible to overinvesting at market peaks. Conversely, during recessions, they might only see gloomy news, confirming their pessimistic outlook and preventing them from seeing nascent opportunities. The transcript powerfully contrasts this emotional reactivity with the calm, planned approach, 231, of those who understand the cycle. These individuals know how to use time as an advantage, 235, employing patience, 129, and discipline, 2142, to act counter-cyclically. This is the essence of value investing, exemplified by figures like Warren Buffett. 1325, be greedy when others are fearful, and contrarian investing, which deliberately goes against prevailing market sentiment. They understand that the greatest opportunities always lie in crisis, 27-2. The core message here is not about predicting the exact timing of peaks and troughs, which is impossible even for top experts, 23, 24, 27-40. Instead, it's about situational awareness, understanding where the economy is in its cycle, 0, 33, 242, 944, 17, and adjusting one's strategy accordingly. This requires a profound self-awareness and the ability to detach oneself from the emotional sway of the market. It is a psychological discipline as much as it is an economic one. The 4 seasons of the economy. A detailed deconstruction. The video's most intuitive and memorable framework is the comparison of economic cycles to the 4 seasons, 0-40, spring recovery, summer expansion, autumn peak, stagnation, and winter recession. Let's delve into each phase with academic and historical context, expanding on the transcript's eloquent descriptions. 1. Expansion Morong, spring, early summer. The transcript describes this as a period of strong economic growth. Businesses hire more, people's incomes rise. Inflation is controlled at a moderate level. 1155, 1451. This phase is characterized by Strong GDP growth, typically above its long-term trend. Rising employment. Unemployment rates fall, and job creation is robust. Labor markets tighten, leading to moderate wage growth. Increased consumer spending. Higher incomes and confidence fuel consumption, boosting retail, tourism, and services, 49 to 56. Business investment. Companies expand production, invest in new capital, and initiate new projects, driven by positive profit outlooks, 39 to 56, 43 to 19. Loose monetary policy, often initiated in recovery. Initially, interest rates might still be low and credit readily available, encouraging borrowing and investment. 15, 6, 17, 55. Optimistic market sentiment. The market sentiment is very positive. Everyone believes opportunities are everywhere. 12, 9, 43 to 26. Stock markets rally consistently, and real estate becomes active. 12, 15, 29 to 19, 43 to 36. Inflation. While controlled at first, inflationary pressures gradually build as demand outstrips supply and resource utilization increases. Academically, this phase is a period of re-leveraging and optimism, following the deleveraging and pessimism of the previous recession. It is where animal spirits return and the economy operates at or near its full potential. However, the transcript astutely notes that expansion does not last forever, 12:21, and that this very excitement sows the seeds for the next phase, the peak, 15. This perfectly captures the inherent self-correcting or self-destructive nature of cycles. Unchecked optimism leads to excesses. 2. Peaked in, late summer, autumn. This is where the economy reaches its highest point before a downturn. The transcript calls it the most dangerous time, 1844. Key characteristics include asset bubbles. Asset prices, stocks, land, are often inflated excessively, forming bubbles 12, 36, 15, 26, 40 to 59, 43 to 57. Speculation dominates over value investing. Overheating economy. Growth is still strong, but unsustainable. Inflation starts to appear. Interest rates gradually rise. 12, 29, 40 to 46. Tightening monetary policy. Central banks, concerned about rising inflation, begin to raise interest rates to cool down the economy and curb excessive credit expansion. 1539, 1826, 40 to 46, 44 to 11. This makes borrowing more expensive, slowing down investment and consumption. High costs. Rising inflation means increased cost of living and production costs for businesses. 18, 19, 33 to 2, 40 to 9. Extreme optimism. The crowd becomes excited, believing prices will rise further. 1243, 1553, 47 to 53. Novice investors, drawn by the perceived easy money, flood the market. 1831, 32 to 50. This is the golden age where they believe that just by participating in the market, they will profit. 43 to 44. Warning signs. Behind this optimism are signs of instability. 1533, 33 to 2. The shrewd ones begin to be cautious, reducing risks. 1248. While the crowd remains blindly confident. 1255. The peak phase is insidious because, superficially, everything looks fantastic. It's the brightest summer, but also the time when the scorching sun signals impending storms. 1248. This is where the emotional disconnect is most pronounced. The crowd, driven by greed and confirmation bias, ignores all warning signs, while the disciplined few begin to de-risk, preserving capital for the inevitable downturn. 3. Recession. Sutwai, the most painful phase, characterized by contraction. The transcript vividly portrays it as the cold, gloomy winter. 13 to 13. Declining GDP. Economic output shrinks for 2 consecutive quarters. Rising unemployment. Businesses cut back, lay off staff, and many go bankrupt. 13.1, 16.7, 18.52, 33-36, 41-20. Falling consumer spending and investment. People tighten their belts, and businesses halt expansion plans. 19.3, 33-41, 44-31. Deflationary pressures, or disinflation. Demand collapses, leading to falling prices in many sectors, though inflation can persist if driven by supply shocks, for example. 1973 oil crisis. Financial market collapse. Stock markets crash, and real estate markets freeze, losing liquidity and value. 13.6, 16.13, 19.3, 30-29, 41-30, 44-38. Previous debts become unbearable burdens. 16.19. Widespread pessimism, panic. People panic, sell off assets, and the general mood is pessimistic. 13.6, 16.13, 18.57, 30-30, 41-37, 44-45. Fear dominates, leading to irrational selling at the bottom. Opportunities for the prepared. It is in this winter that the seeds for the next spring are hidden. The cheapest assets, the best opportunities always appear during a crisis. 13, 18, 19.3, 30-29, 41-37, 44-52. This is the time for courageous, counter-cyclical investing, as advocated by Warren Buffett. Recession is the most difficult phase, 13.1, but it is also the crucible that forges future wealth. It separates the speculators from the investors, the emotional from the disciplined. As the transcript notes, it's a time when real value emerges. 16.26. 4. Recovery fuck hoy. Spring. This is the turning point, the nascent phase of rebirth. Recovery begins to appear silently, often in the suspicion of the crowd. 30-57, 45-5, 1 hours and 57 seconds. Government stimulus and monetary easing. Governments inject money into the economy. Central banks lower interest rates, and credit becomes cheaper and more accessible. 16.39, 19. 23, 30-37, 41-50, 45-5. Stabilizing economy. GDP stops falling and begins to show modest growth. Job market improvement. Businesses slowly start hiring again, and unemployment gradually declines. 16.51, 19.23, 37-43, 41-56, 100. 57. Return of confidence. Confidence gradually returns. 16.46, 19.31, 30-37, 41-56, 2 mature, 146, 146, 41-56. Initially weak, it spreads as economic data improves. Financial market rebound. Stock markets often bottom out and begin to rally before the real economy fully recovers. 16.57, 19.38, 30-29, 37-50, 42.03, 45-23. This is because markets are forward-looking. Skepticism. Initially, very few people believe. 16.57, 31-9, 41-56, 45-5, due to the fresh memory of the recession. This skepticism provides opportunities for those with foresight to invest before the crowd. Recovery is the spring of rebirth, 1344, where the seeds planted during the winter of recession begin to sprout. It is often a period of significant gains for those who had the courage and foresight to buy when others were panicking. The key insight is that this phase closes the cycle, but also simultaneously opens a new journey, 17.4. The beauty of this 4 seasons framework lies in its simplicity and universality. It offers a powerful lens through which to view economic history and current events, empowering individuals to move beyond emotional reactions and adopt a more strategic, cyclical perspective. It's about accepting that change is the only constant, 38-7, and preparing for each inevitable shift. Global case studies, echoes of the cycle across continents. The transcript effectively uses historical examples to illustrate its points. Let us expand on these, adding academic depth and international context, adhering to the under 40% original content rule by using the transcript's examples as springboards for broader discussion. 1. The 1973 oil crisis and the Kondratiev wave. The transcript briefly mentions the 1973 oil crisis 739, Kung Hoang Do Mor, Num 1973, where OPEC's oil embargo caused prices to quadruple. This event perfectly exemplifies a supply-side shock triggering a global recession. It was a catalyst that accelerated the end of one Kondratiev wave, driven by mass production and automobiles, reliant on cheap oil, and the beginning of another, forcing a re-evaluation of energy sources and efficiency. Academic context. This crisis led to stagflation, a portmanteau of stagnation, slow growth, high unemployment, and inflation rising prices, a phenomenon that defied traditional Keynesian economics, which suggested inflation and unemployment had an inverse relationship. It underscored the limits of demand-side management and highlighted the crucial role of supply-side factors, especially commodities, in global economic stability. Long-term impact. The crisis spurred massive investments in energy efficiency, smaller cars, better insulation, nuclear power, and later, renewable energy. It also led to a global shift in manufacturing, as high energy costs pressured traditional industrial hubs. This was a classic Schumpeterian destruction event that ultimately paved the way for creative innovation in energy and manufacturing. 2. Japan's lost decades, the bursting of an asset bubble. 8. 23. The vivid example of Japan in the 1980 seconds. 8. Nyutban, Nyungnam 1980, where real estate and stock prices soared to irrational heights. Duta Tokyo Datten Mukban, Mut Kung Vin Kung Mudu Kaban, California. Land in Tokyo was so expensive that selling one park could buy the entire state of California, 829, only to burst in the early 1990 seconds, is a textbook case of an asset bubble and its prolonged aftermath. Academic context. This bubble was fueled by excessive credit expansion, ultra-low interest rates, and a pervasive belief in Japan's unstoppable economic prowess. The Bank of Japan's attempts to prick the bubble by raising rates in the late 1980 seconds ultimately led to its spectacular collapse. The subsequent lost decades, 9-5, were characterized by persistent deflation, zombie banks, banks holding non-performing loans, and consumer deleveraging. It demonstrated the dangers of both financial exuberance and belated insufficient policy responses. Japan's experience remains a cautionary tale for policymakers worldwide about the perils of allowing asset bubbles to grow unchecked. Behavioral aspect. The Japanese bubble also highlighted collective irrationality. The belief that this time it's different, a common cognitive bias during bubbles, was strong. The psychological impact of prolonged asset price declines profoundly affected consumer and business confidence for decades. 3. The dot-com bubble, 2000 Schumpeterian destruction and creation. 146. The transcript references the dot-com bubble of 20001. 46. Num 2000. Bongbongrot.com Noitang, where thousands of internet companies disappeared. Investors lost all their money. This was a classic speculative bubble driven by irrational exuberance over the nascent internet economy. Academic context. Fueled by venture capital and public market enthusiasm for any company with a .com suffix, valuations detached entirely from fundamentals. When the bubble burst, it demonstrated the brutal efficiency of market corrections, wiping out unsustainable business models. However, as the transcript rightly points out, in those ruins, Amazon, Google emerged and became the giants they are today. 153. This is the purest illustration of Schumpeter's creative destruction. The unsustainable parts of the internet economy were destroyed, but the fundamental, truly innovative core search engines, e-commerce, cloud computing not only survived but thrived, laying the groundwork for the next generation of technological growth. 4. The 2008 global financial crisis, a credit-driven recession. 0. 12. The 2008 crisis. 0. 12. Hainulainam 2008 is perhaps the most salient recent example of a major recession, triggered primarily by a credit bubble in the U.S. housing market. Academic context. This crisis exposed deep flaws in financial regulation, excessive securitization of subprime mortgages, and interconnectedness of global financial institutions. When the housing bubble burst, it triggered a cascade of defaults, leading to widespread financial panic and a global recession. Central banks and governments intervened with unprecedented monetary and fiscal stimulus, quantitative easing, bank bailouts, to prevent a total collapse. Contrast and opportunity. The transcript highlights the classic cyclical opportunity. A few months, millions of families in the US and Europe lost homes, jobs, but in that very period, a few people boldly bought cheap stocks, accumulated real estate at record lows, 0.18. This perfectly illustrates the fear and greed dynamic and the cyclical opportunity that arises when assets are sold off indiscriminately due to panic, rather than fundamental value. 5. Vietnam's real estate cycles, 1:16:27-9, 56-56. The transcript grounds its abstract concepts in concrete local examples, particularly Vietnam's real estate cycles. 1:16. Num 20113. But Dong San Roy Vao Trong Thai Dong Bang. 27. 09. Ki But Dong San. Dong Bang Gi Duan. 2011-2013. Academic context. Emerging markets often experience more volatile and pronounced cycles than developed economies, particularly in asset-heavy sectors like real estate, due to factors like less mature financial systems, higher sensitivity to capital flows, and sometimes speculative bubbles fueled by rapid development and lax credit standards. The 2011 to 2013 freeze in Vietnam was a period of severe illiquidity and falling prices, reflecting an earlier period of over-speculation and credit expansion. Local relevance. By providing these specific local examples, the video makes its message highly relevant and actionable for a Vietnamese audience, demonstrating that these universal laws of economics play out in their own backyard, not just in distant global financial centers. The emphasis on Ka Ko Lai Hat Dong, Chuen Hung Ra Tuan Ko, restructuring operations, globalizing 8, from the Japanese example can also be seen as a relevant lesson for Vietnamese enterprises. These varied historical illustrations, spanning different geographies and economic sectors, powerfully reinforce the central theme. Economic cycles are a universal, relentless force. They are neither good nor bad in themselves, they simply are. The crucial variable is human response. Whether one rides the wave with understanding and discipline, or is swept away by emotion and unpreparedness.
This segment brilliantly connects macroeconomics to micro-level decisions, demonstrating that understanding cycles is not just for billionaires, but for everyone. It underscores the importance of a life cycle approach to financial planning, adapting strategies based on both age and the prevailing economic season. 1 hour, 1 minute, 30 seconds. Investment strategies by asset class, 5318. The transcript outlines specific strategies for different asset classes across the cycle, a practical framework that resonates with institutional asset allocation models. Stocks, Chung Koan. Expansion. Focus on growth stocks, 5351. Companies expanding market share, innovating, or leading their sectors. Peak. Shift to defensive stocks, 5429. Essential consumption, utilities, healthcare. Less affected by downturns. Increase cash/safe assets. Recession. Seek value stocks, 5509. Fundamentally strong companies, low debt, stable cash flow, but undervalued by the market due to panic. Recovery. Boldly increase positions, 55-36, combining value and growth as confidence returns. Real estate, Bat Zhongsan, expansion, steady price increases, strong demand. Good for buying in correct areas, 56-15. Peak, prices often overinflated, 56-20. High risk due to potential credit tightening. Avoid getting capital trapped, 56-28. Recession, liquidity freeze, sharp price drops. Opportunity for those with cash to buy real value assets, 56-42, in good locations. Recovery, prices rebound significantly. Assets bought in recession multiply in value. Gold and safe haven assets, Vang Va Kach Tai San Tru An. Peak and recession. Their role is strongest here, 57 minutes and 6 seconds. Gold acts as a hedge against inflation and instability when confidence in fiat currency wanes. Expansion and recovery. Gold typically becomes less attractive compared to equities or real estate, 57-17. The strategy is to know when to hold for defense and when to reduce to shift to growth assets, 57-24. Startups and business, Koin Hip Va Kin Duan. Expansion and recovery. Easiest time to succeed, 57-36, due to capital availability, high confidence, and willing customers. Recession, major challenge, but also a filter, 57-49, for truly resilient business models. Companies born and surviving recessions often lead the next cycle. This granular tactical advice transforms the abstract theory of economic cycles into a concrete action plan, illustrating how an understanding of the macro environment directly informs micro-level decision-making across diverse asset classes and life stages. It's a testament to the comprehensive nature of the video's underlying economic framework. The global canvas. Macro trends shaping the next cycle. The transcript broadens its perspective to global trends, recognizing that current cycles are not isolated but intertwined with overarching macro forces. It highlights several critical trends that are likely to shape the next long-term economic cycle. 1 hour, 3 minutes, 3 seconds. 1. Artificial intelligence and digital technology. 1 hour, 3 minutes, 30 seconds. The explosion of AI, 1 hour. 0336 is compared to electricity in the 20th century, a core invention capable of transforming production and consumption models. Academic context. This is a classic example of a technological paradigm shift, driving a new Kondratiev wave. AI, machine learning, and advanced data analytics are not just incremental improvements. They are foundational technologies impacting productivity, innovation, and global competitiveness. Economies that effectively integrate and leverage AI will likely lead this new cycle, driving unprecedented productivity gains and creating entirely new industries. This echoes Schumpeter's emphasis on innovation as the engine of long-wave cycles. The transcript also wisely hints at the risk of bubble, 1 hour, 4 minutes, 2 seconds, if excitement outpaces fundamental value, a common occurrence during periods of rapid technological adoption. 2. Green energy and sustainable transition. 1 hour, 4 minutes, 9 seconds. Climate crisis, weather changes, and the need for emissions reduction are forcing a restructuring of economies towards renewable energy, electric vehicles, EVs, battery storage, and green materials. 1 hour, 4 minutes, 14 seconds. Academic context. This represents a massive reallocation of capital and a significant industrial transformation. It is driven by both environmental necessity and policy mandates, e.g. carbon pricing, renewable energy targets. The shift from fossil fuels to renewables is a structural change with far-reaching implications for energy markets, geopolitics, and global supply chains. Countries investing heavily in this transition, like Vietnam, 1:43.50, stand to gain significant competitive advantages. This is a long-term, multi-decade trend, influencing investment decisions, job creation, and geopolitical alignments. 3. Global capital flow shift. 1 hour, 4 minutes, 48 seconds. The transcript notes a shift from Western dominance to Asia, China, India, Southeast Asia, and specifically, Vietnam as new destinations for capital. Vietnam is highlighted as a new global manufacturing hub, 10501. Academic context. This reflects the ongoing rebalancing of the global economy, driven by demographic shifts, rising middle class in Asia, urbanization, infrastructure development, and diversification of global supply chains, de-risking from over-reliance on a single region. This trend has profound implications for global trade, investment, and currency markets. The reshoring and friendshoring phenomena, catalyzed by geopolitical tensions and supply chain vulnerabilities, are accelerating this shift, benefiting nations with competitive labor, stable governance, and strategic locations like Vietnam. 4. Geopolitical factors. 1 hour, 5 minutes, 24 seconds. Conflicts, power competition, and global trade fragmentation are acknowledged as factors capable of creating unexpected fluctuations, 1 hour, 5 minutes, 31 seconds, in economic cycles, redirecting capital flows and altering national trajectories. Academic context. Geopolitics have always been a significant, albeit often unpredictable, exogenous shock to economic cycles. Trade wars, sanctions, military conflicts, and shifts in alliances can disrupt supply chains, impact commodity prices, for example, energy, rare earths, and deter foreign direct investment, FDI. This emphasizes that economic analysis cannot occur in a vacuum. It must integrate geopolitical risk assessment, making political economy a critical discipline for contemporary investors and policymakers. The transcript correctly notes that this requires not just looking at numbers, but also closely monitoring political movements. 1 hour, 5 minutes, 42 seconds. These macro trends are not independent variables. They interact and amplify each other, creating a complex, dynamic environment for the next economic cycle. The ability to discern these megatrends and their interplay will be crucial for navigating the opportunities and challenges they present. The transcript implicitly argues that understanding these global shifts is an extension of understanding local cycles. The same principles of preparedness, adaptation, and discipline apply, but on a grander, more interconnected scale. A philosophical conclusion: the compass of cycles in a sea of change. The provided transcript culminates not just in a summary of economic principles, but in a profound philosophical reflection on human behavior and the nature of prosperity. It reiterates the central truth: the cycle always repeats: expansion, peak, recession, recovery, like 4 seasons succeeding each other. 1 hour, 6 minutes, 46 seconds. The most enduring message is not about controlling the cycle, which is impossible, but about preparing for it. Just as a farmer cannot prevent winter, but can prepare for spring, 1 hour, 6 minutes, 51 seconds, an investor cannot prevent a recession, but can position themselves for the subsequent recovery. The core philosophy can be distilled into several key tenets. 1. Emotional detachment as a superpower. The transcript's most repeated advice is to not let your emotions run contrary to the cycle. 1:07:10. This requires a profound level of self-awareness and discipline. When the crowd is euphoric, cultivate caution. When they panic, maintain calm. When they doubt recovery, observe and dare to go first. 1 hour, 7 minutes, and 18 seconds. This counterintuitive behavior, born of understanding, is what separates the successful few from the struggling many. It's about recognizing that collective sentiment is often a lagging indicator, not a reliable guide. 2. Sustainable wealth is long-term. The video explicitly emphasizes sustainable wealth. 1 hour, 8 minutes, 16 seconds. Rejecting quick, rich schemes. It argues that true prosperity is built step by step through multiple cycles. 10848. This intergenerational perspective is crucial. Wealth accumulated during a boom becomes a shield during a downturn, and preparation during hardship becomes a launch pad for recovery. 10909. This long-term view fosters resilience, discouraging impulsive, high-risk behaviors that often lead to ruin. 3. Crisis as opportunity, not the end. A consistent thread is that crisis is not the end, but merely a pause to prepare for a new melody. 1 hour, 8 minutes, 34 seconds. Opportunities never disappear. They merely shift from the hands of the unprepared to the hands of the patient and disciplined. 10840. This reframing of adversity is empowering, shifting the focus from fear to strategic action. It encourages a proactive mindset, seeking value when others are liquidating assets indiscriminately. 4. The cycle as a compass. The transcript's concluding metaphor is powerful. Let the economic cycle be your compass. 11202. This transforms an abstract concept into a practical tool for daily decision-making, from personal spending and debt management to major investments and entrepreneurial ventures. By asking, what stage is the economy in, and what does that mean for my choices? 11207. Individuals can avoid countless mistakes and seize valuable opportunities. It's about adaptive navigation, not rigid prediction. 5. The empowerment of knowledge. Ultimately, the video is an ode to knowledge. It posits that understanding cycles changes how you see the world, and, from there, changes every financial decision in your life. 1 hour, 9 minutes, 35 seconds. This intellectual empowerment is the most profound takeaway. It liberates individuals from being swept away by fluctuations without understanding why. 1:1154. And transforms them into conscious participants, capable of aligning their actions with the deeper rhythms of the global economy. In a world increasingly defined by rapid change, technological disruption, and geopolitical volatility, the timeless wisdom of economic cycles offers an anchor. It reminds us that while the surface may churn with unprecedented speed, the underlying currents often follow predictable patterns. The ability to discern these patterns, to act with discipline over emotion, and to cultivate a long-term perspective is not just a financial strategy. It is a fundamental life skill. It is the wisdom that enables us not merely to survive the storms, but to harness their power, navigating our personal and professional journeys with greater confidence, resilience, and enduring prosperity. The economic cycle, in its relentless repetition, offers not a threat, but a profound, recurring invitation to wisdom.